Well, Charles, thanks so much for taking the time today to really just give us a bit of an insight into some adjustments that were made in the portfolio. I understand with, the way the markets are right now, people are kind of curious as to what their holdings are and why they hold what they own. And it appears that there was an adjustment that you made in the portfolio. It looks like uh, you removed your position in Eaton Corp and you added your position into Nike, which is what we're seeing on the screen. So perhaps you can share with us what it was that said, "Hey, now's the time to make this happen." So I'll pass it over to you. I'm curious to hear about how that all unfolded.
Okay, thanks, Scott. Well, given the massive correction that we've had, certainly the biggest since 2008, when we have a correction, it gives us an opportunity to buy companies or upgrade companies that we've had on our wish list for quite a while. And one of the problems is that the better companies or the good to great companies a lot of times are trading way beyond where they should be, mainly because of the expectations what the market has because they've been so good in the past. So the reason we keep the list of these companies that we like is for when we have corrections like this. So a lot of people get upset and concerned about a correction in the marketplace. But what we're doing is we're on a shopping list. So we have a shopping list that we have that when we get an opportunity with a market correction to upgrade, we love that. And that's Nike.
So basically, what you're saying is that it's been on your wish list for a while, but until it went on sale, you weren't willing to acquire it, and it just went on sale.
That's right. And to give you an example in context, I waited because of the market expectations being so high, which is what we deal with all the time. I waited for Walmart and I waited for Coke. It took me 9 years to be able to buy them at the price I wanted to buy.
Right.
So for 9 years, we waited on the wish list, and it finally came down through a massive correction, of which we purchased, and both those stocks doubled very quickly. So it's a short list of best of breed companies, and we use this as an opportunity. So hopefully, when we buy Nike now, we're going to be holding on to Nike for years. But it gives us an opportunity, and it doesn't really make a lot of sense overpaying for a good company, even though it's a good company, but we're looking at return on capital and we're looking at growing the accounts, and we don't want to sit sideways for the price to catch up with the company.
Yeah. So I mean, what I'm hearing then is great companies aren't always great investments until their price is right.
That's right. And if you overpay for a bad company, you got a massive problem. But if you overpay for a good company and a good business, then what you're doing is you're just hiding money for a long time.
Right. But then when you've
So
got an opportunity like this where suddenly there's this market event that drives the prices of everything down. Now it's like, well, wait a minute, this is still a great company, but now I can get it at a really good price.
right, and the way that we make money and the way that we buy things is that we look at what the market says it's worth. So I'm not looking at what I think it's worth or some analysts say that it's actually worth. We look at the market. And if the market says, okay, it's trading at $90, then we do a deep dive on what we think, given the past and the returns of the company and the growth rate. We do some in the weeds thing to decide that the market has it wrong. So obviously at $180, Nike was way overvalued because the expectations were high. So we say no. Now we get down here, the expectations are way too low, but they're low because of the market correction. And a lot of times good companies are sold because people get margin calls and they're losing money and they're selling the best companies that haven't gone down the most. So what we deal with expectation. So if we bought this stock 3 or 4 or 5 years ago, it would have been just wasted money, lost opportunity. So we wait for the market to come to us. Now we might, if we didn't have this correction, we might never have bought Nike, or we won't buy anything unless the market comes to us. but we've got a list of companies that we love, and that's why we wait to come to us.
I almost envision the patience grasshopper, right? It's an exercise in patience for that, because you know your numbers, you know what you would be willing to pay for a company, but for the market to actually bring that to you might take some time, which is what you've clearly indicated. So what's with regards to this thing? So what were the telltale signs that said, hey, this is the time to be to moving into this?
Well, mostly the biggest, the most important metric of a company in terms of investing in the company and in terms of the success of a company, doesn't matter what company, is its return on invested capital. White papers have been submitted that calculate about 60% of the return of companies that you buy has to do with return on invested capital. So that's a very important number. And it's like anybody that owns a company, if you can make more and more money and a very high return on the money that you invested in your business, the more valuable the company is. And the stock price always follows the value. But we don't want the value to go up and then come down and come up and down like tech stocks or something, because we have no predictability factor of what the company's going to do 1 year or 2 years or 3 years from now, which is why we don't buy those kind of businesses. So at $180, it was overvalued, and now it's at $90, and the return on invested capital is 29%. That puts it in from a best of breed companies and a company like Nike, a worldwide entity, that puts it in the 1% of valuable companies. So we don't get an opportunity to buy these all that often unless the market helps us with a correction. So the 29% is very important.
So that's pretty amazing then when you consider, because that's really, I think, where once you see, if they're not doing the deep dive like you've done and what we're seeing in front of us right now, then they're not seeing that, the calculation shows a return on invested capital of 29%. Now, that may show itself over time, but it will show itself, and then the price is going to be reflective of that as the price continues to rise. But it's the ability to see that at the time when it's happened, because this is the market has corrected. There's a lot of emotion running wild, and people left to their own devices are probably saying, well, how can I stop the bleeding? What they're not doing is they're not taking advantage of the fact that by saying, well, how can I take advantage of this? Because we know that there's a pendulum has swung potentially. Some could argue that it swung a little bit too far, and these opportunities present themselves. But if you don't have the ability to actually see the opportunities, and what I like about what you said is that you've got this wish list, and that wish list is there, and it's what I'd love to own, and this would be great, but I'm not going to overpay for it. But then suddenly, I'm sure if you've got a dashboard that sort of has, call it alarms or triggers or whatever on it, that it must have just lit up at a certain point saying, here's some really good opportunities out there. And this is what you're saying is the reason why Nike suddenly, it's been on your radar for a while, but now it's showing up, and, here's an opportunity that, you don't want to look a gift horse in the mouth, so to speak.
No, and that's important. And here's what's important is if you're going to buy something, if you're going to invest in a company, you need to know two things. How much is it worth? And how do you know? So the only way that you can understand what it's worth is you have to do a deep dive, and you have to do massive amounts of adjustments to make sure that the gap accounting, reconcile the gap accounting with the economics of the business. So anybody that owns a business, and a small business doesn't have to be a public company, here's how much money I put in, and here's how much cash I took out. That's all we're trying to do. We're trying to equalize all companies on the same basis. So when you do a deep dive and you understand that earnings per share is only opinion, that they didn't really earn that, and they did this with pension, they did this, we have to adjust for that. Now, once we adjust for that, we get a number. And then we do some other things in terms of discounting the no growth factor and all that. I won't get into that right now. So you need to know what the company's worth. Now, we don't know what Amazon's worth, and we don't know what Netflix is worth, because we don't know what they're going to make 5 minutes from now, which is why we don't go into those massive growth companies that people are hoping down the road they're going to benefit from, which we've seen a lot of these companies. Peloton went from $190 to $7.
Yeah, I mean, what you're referring to there then is the fact that you've got a filter that you've put on that says, okay, maybe somebody says it's a great company, but if you then can't, have a predictability factor built into it, then
Right. I don't care if somebody says it's a good company, and I don't care what a research guy says, and I don't care what the CEO says. I don't care about that. What I care about is looking at the bottom numbers. What is the cash return on the invested capital, which is why it's the biggest metric. So I don't want to listen to the noise. I want to see. Now, when you look at a company like Nike, there's predictability, there's worldwide support and worldwide distribution and things like that. That's important. So you get to know what the good businesses are and the good companies, but a lot of times you can't get them because the market's up so much because of zero interest rates. So you need to do the fundamentals, which is why we haven't been hit. Now, the other thing is, contrary to what the public thinks, is the money that's made in the stock market is made on the downturns. You make your money on the downturns, not the upturns. In other words, Nike's at 190, now it's at 80. Okay, that's how you make the money, going in at 80 buying or 90 buying Nike, or buying when the companies have been down quite a bit. And the market always overshoots on the upside or on the downside. So we're just looking for downside, mispriced opportunities of good businesses, and we'll sit forever to buy the company, or I just won't. There are companies I've never been able to buy because the expectations are way too high.
Yeah, right. And it's so interesting because what I hear from a lot of people who are on the do-it-yourselfer is they never, when they say, oh, I'm buying this, or this is a company I like, but they're never talking about the fundamentals. They're talking about the story around the company. And the story.
And one of the biggest ones that was BlackBerry.
Yeah.
Because when BlackBerry was hot, my kids were saying, buy BlackBerry, everybody's got BlackBerry. You wouldn't believe how great it was, and then they go into the tank.
Yeah. Right.
So if you're not understanding the value of the business, then you're a momentum player. And momentum players, it goes up, then it goes down, and it's gone down a lot now, and it went down a lot in 2008. So you think of all the hedge funds and companies that have gone bankrupt in the last month because they own. Well, look at ARK, for example. They're down 60% for the year. So we don't play the game. We pick the businesses that we like, and we buy them at not a cheap price or even a discounted price as much as a fair price.
Right. Well, that's great. I mean, it's great to see the level of quality in the portfolio. When you go through the listing of the sort of the best of breed companies that you've got in there, the fact that you've just been doing some upgrading to that list is fantastic. And really, I think the way you analyze this and the way you make the decisions has nothing to do with emotion and everything to do with logic. And I can't tell you how many people I wish they would understand that if they let their decision-making process be driven by emotion, they're going to be wrong every time.
But see, that's the thing, that if you understand what you're doing, and if the client understands why they're in these businesses, and then the market corrects, that's a positive thing, not a negative thing. It's not as if, okay, now you're going to lose money and now you're going to have a big problem. People are, but we're not involved in those kind of businesses. Mm-hmm. So if they understand just the fundamentals of why we buy businesses, the quality of the businesses, they're going to be happy.
You
And
know,
especially now when we have gone through a correction and they've looked at what the portfolio has done through a correction, they're happier now than they were before.
yeah, absolutely. And you said a good point there. You said, the understanding about why you buy the businesses, but it's also, I think, what it really comes down to is when you buy the businesses. Because again, people will make decisions from an emotional standpoint because they see the company in the news, or they just feel like it's a good, but they haven't done the deep dive. And it's that deep dive that allows you to know when to buy a great business.
And the other thing is when you do a deep dive, a lot of people wouldn't be able to do the deep dive because they wouldn't have the knowledge base to understand how to do the deep dive.
Well, there's nothing sexy about the deep dive, I'm sure.
No, but the companies, the people that I use have you're going to go through 200 or 300 pages of footnotes, and you have to adjust and reconcile all kinds of things to get to the point where, okay, this is the actual cash that the company made, the net cash. So there's a lot of companies and businesses that don't do that because it's one, too expensive, and two, the know-how is very complicated and complex.
Yeah, yeah, absolutely. Well, this is super. Well, I really appreciate you taking the time to go through sort of what it was that brought you to bringing Nike into the portfolio and using it as the company to upgrade the portfolio. And I always look forward to our discussions, and always look forward to finding out more about what the next opportunity is when it comes up. So, thanks so much for taking the time today, and
Thanks,
yeah,
Scott.
we'll always look forward to our chats in the future.
Okay, thank you.